Imagine you have $1,000 to invest. Most people immediately think, which stock should I put this money into? Or which mutual fund will give me the best returns? But a traditional Jewish investor thinks something completely different. They ask themselves, what's the worst thing that could happen with this money? And how do I prepare for it? This difference in the first question they ask, this difference in how they frame the problem itself, explains why their long-term results are so radically different. It's not that Jewish investors are smarter or have access to secret information. It's that they operate under a fundamentally different set of assumptions about how the world of money actually works. And what's most fascinating is that these assumptions, when you examine them closely, are supported by centuries of empirical evidence, but contradict almost everything the modern financial industry tells you to do. The first principle that makes investing work is something that sounds pessimistic, but is profoundly practical. Assume something bad is always about to happen. This isn't paranoia, it's probability. In any 30-year period, you're statistically going to face at least one major recession, possibly a depression, perhaps a war or political crisis. This isn't speculation, it's history. Average investors invest as if the future is basically a straight upward line with small, temporary dips. Jewish investors invest assuming the future will include multiple devastating crises, and they structure their portfolios to not only survive those crises, but also take advantage of them. This difference in mindset changes everything about how you build a portfolio. When you assume a crisis is inevitable, you're never fully invested. You always have cash on hand. When you assume something bad will happen, you never concentrate everything in one asset class, even if that asset is performing incredibly well. When you assume future crises, you don't get too excited during the good times because you know they're temporary. The second principle, which contradicts all modern portfolio theory, is that they invest in groups of assets that individually look like bad investments, but collectively are brilliant. Business schools teach that you should eliminate low-performing assets from your portfolio. Jewish investors deliberately hold onto some assets that will never yield great returns because they serve a different function. They are anchors of stability. Here's the perfect example. A typical portfolio might be 100% high-growth stocks because they historically deliver the best returns. A traditional Jewish portfolio might be 40% stocks, 20% boring bonds, 20% real estate, 10% cash, and 10% physical gold. If you calculate average annual returns, the traditional portfolio wins on paper. But here's what the theory doesn't capture. The Jewish portfolio never forces you to sell at the worst moment. When a crisis hits and you urgently need money, the traditional portfolio forces you to sell stocks when they're collapsing. The Jewish portfolio allows you to withdraw from cash or sell bonds or even sell some gold without touching stocks when they're down. This means your stocks can fully recover while other investors had to sell theirs at a permanent loss. Over the long term, this flexibility outweighs the theoretically higher returns. The third principle is something the financial industry hates to admit. Transaction costs and taxes matter more than gross returns. Average investors are obsessed with finding investments that earn 20% annually. Jewish investors are obsessed with keeping the maximum percentage of whatever they earn. This manifests itself in specific behaviors. First, they buy and hold for decades, not years. Every time you sell an investment at a profit, you pay taxes. If you hold an investment for 30 years, you pay taxes once at the end instead of multiple times. That compounding difference is massive. Second, they structure their investments to minimize tax friction. They prefer stocks that pay qualified dividends rather than interest because dividends enjoy favorable tax treatment. This isn't tax avoidance. It's smart tax efficiency. If you find this video helpful, please give it a like and subscribe to the channel so you don't miss our next content. The fourth principle that makes their approach work is they value peace of mind more than maximum returns. This sounds soft and emotional, but it's extraordinarily practical. When your portfolio is structured so you can sleep soundly during crises, you make better decisions. When you're constantly stressed by volatility, you make stupid emotional decisions. Behavioral finance research repeatedly confirms this. Investors who experience less emotional volatility outperform investors who experience higher returns but constant stress over the long term. Why? Because stressed investors panic sell during crises, precisely the worst time. Calm investors hold their positions or even buy more. This is why Jewish investors are willing to sacrifice 3 or 4 percentage points of annual return to have a portfolio that allows them to sleep soundly. It's not emotional weakness, it's strategic advantage. The fifth principle is treat different segments of money with completely different philosophies. Typical financial advisors apply the same investment strategy to your entire wealth. Jewish investors segment their capital into completely different categories with different rules. They have never touch money, which is ultra-conservatively invested in government bonds and cash, designed to survive literally any scenario. They have opportunity money, which is liquid, waiting for crises to buy undervalued assets. They have growth money, invested more aggressively in stocks and businesses. And they have learning money, which they deliberately risk in speculative investments to gain experience. Each segment has different rules, different goals, and different time horizons. Never touch money is left untouched, even if there's an incredible opportunity. Opportunity money is left uninvested, even if the market is rising, because it specifically waits for downturns. This mental segmentation creates a portfolio discipline that's impossible to maintain if you treat all your capital as a single segment. The sixth principle that explains their success is something that requires extraordinary patience. They're willing to look stupid for years if they know they're doing the right thing. Average investors can't stand looking bad. If all their friends are making money in technology, and they aren't, they eventually give in to social pressure and buy at the worst possible time. Jewish investors have a different psychological mechanism. They've internalized that being out of step with the crowd is often the right position. They don't care if their friends are getting rich in cryptocurrencies while they hold boring municipal bonds. They have conviction in their strategy that comes from mindsets proven over generations, not from results from the last 6 months. David Tepper is famous for holding massive amounts of cash during extended market rallies, refusing to invest while everything else is going up. His clients complain, the media criticizes him. But then the crisis hits, prices collapse, and Tepper deploys massive amounts of capital by buying quality assets at absurd prices. He has repeated this cycle for decades, and each time he faces the same criticism during the holding phases. The difference is that he doesn't mind looking temporarily stupid. The seventh principle is perhaps the most important. They spend as much time learning from their mistakes as they do celebrating their successes. The financial industry is obsessed with analyzing winning investments. Jewish investors are equally obsessed with exhaustively analyzing their losses. When an investment goes wrong, they don't simply absorb the loss and move on. They do something that sounds masochistic but is incredibly valuable. They exhaustively document which signals they missed, which assumptions were incorrect, and what they could have done differently. This documentation becomes institutional knowledge that prevents repeating the same mistake. Jewish investment families literally have mistake books that they pass down through generations. Detailed documentation of bad investments, what went wrong, what warning signs existed. This compounded negative knowledge is just as valuable as the positive knowledge of what works. It makes you immune to entire categories of mistakes that others repeatedly make. The eighth principle that makes their approach work is something that contradicts the modern obsession with perfect timing. They prioritize consistency over optimization. Average investors are constantly looking for the perfect moment to enter and exit. Jewish investors do something simpler. They invest consistent amounts at regular intervals regardless of market conditions. This approach, known as dollar-cost averaging, sounds boring but is extraordinarily effective over the long term. When prices are high, your money buys fewer units. When prices are low, your money buys more units. Averaged over decades, you automatically buy more during the best opportunities without trying to predict anything. But they do something additional that most don't. They consistently increase the amount they invest each year. If you invest $1,000 monthly this year, you invest $1,100 the next year and $1,200 the following year. This compound increase in contributions has a massive impact on the bottom line that most models underestimate. The ninth principle is they measure success by what they didn't lose, not just by what they won. Ordinary investors measure success by comparing their returns against market indices. If the market rose 20% and they gained 15%, they feel like failures. Jewish investors ask a different question. How many crises have I survived without permanent losses? This metric completely changes how you evaluate your own performance. An investor who earns average returns of 12% over 30 years, but never suffers a permanent loss, is infinitely more successful than an investor who averages 18%, but suffers a 40 or 50% loss every decade that forces them to start over. The math of compound returns is brutal. If you lose 50%, you need to gain 100% just to get back to square one. Every big loss puts you in a hole that's extraordinarily difficult to climb out of. Jewish investors are obsessed with never falling into those holes, even if it means giving up a few years of spectacular returns. The 10th and final principle is arguably the most powerful. Treat investing as a multi-generational family project, not an individual hobby. When you invest solely for yourself, your time horizon is your lifetime. When you invest as a family project, your time horizon is decades or even centuries. This difference in time horizon changes everything. Decisions that seem suboptimal over 5 or 10-year horizons are brilliant over 50-year horizons. The sacrifice of returns for stability, the obsession with tax costs, the accumulation of generational knowledge, all of this only makes sense when you think in multi-generational terms. This also explains why they are willing to invest massive amounts of time in educating the next generation and makes wealth self-perpetuating rather than something that typically dilutes over 2 or 3 generations. What makes all these principles so powerful is that they create an anti-fragile investment system. It isn't resistant to shocks, it's strengthened by them. Every crisis makes investors who follow these principles relatively stronger because they survive while others are wiped out, and because they have capital available to buy into the best opportunities. This is the uncomfortable truth the financial industry refuses to admit. Its business model depends on frequent transactions, management fees, and complex products. The traditional Jewish approach to investing minimizes all of these things. They buy and hold, minimize transactions, maintain simple structures, and avoid complex products. This dramatically reduces fees, but it also reduces opportunities for the financial industry to extract value. You don't need to adopt all of these principles to benefit. Even implementing 2 or 3 can transform your long-term results. The first one I'd recommend: stop measuring your success by how much you made this year and start measuring it by how many crises you survived without permanent losses. That metric shift alone will fundamentally change how you invest. If you enjoyed the video, give it a like and subscribe to the channel and share it with someone you think might find it useful. See you next time.